Your retirement account is about to buy a company losing $5 billion a year, and nobody is going to ask you first. That is not a metaphor. It is not hyperbole. It is the precise mechanical outcome of 3 rule changes Nasdaq quietly adopted on May 1st, rules engineered with the specificity of a surgical instrument, timed to coincide with the largest initial public offering in the history of capital markets. SpaceX, $1.75 trillion target valuation. To contextualize that number, it exceeds the combined market capitalization of every American defense contractor. It exceeds the sum of Coca-Cola, McDonald's, Disney, Nike, and Starbucks. It exceeds the top 10 companies listed on the London Stock Exchange combined. This is not a company valuation. It is a demand manufacturing event, and the demand, by design, is you. Before examining the mechanism of extraction, understand what you are actually being asked to buy. SpaceX is not a rocket company. The public perception is wrong, deliberately perhaps, but wrong. SpaceX is 3 distinct business units operating under a single capitalization umbrella, each with radically different financial profiles. The first business is the one you recognize, the Rocket Launch Division, orbital contracts, NASA cargo missions, crewed spaceflight, government payloads. In 2024, this unit generated approximately $4 billion in revenue. Against a $1.75 trillion valuation, that is a revenue multiple that only makes sense if you believe the rocket business has already colonized Mars and is billing for the real estate. It has not. It is a fine business, a good business even, but it is not a $2 trillion business. The second is the crown jewel, Starlink, a low Earth orbit satellite internet constellation that is, without exaggeration, the fastest scaling telecommunications company in recorded history. 10,000 satellites, 10 million active subscribers across 150 countries. Maritime coverage, commercial aviation integration, a classified defense layer, Starshield, operating under contract with the National Reconnaissance Office and the Pentagon. In 2025, Starlink generated $11.4 billion in revenue, 61% of SpaceX's total. Profit margins, 63%, up from 41% just 2 years prior. 20 points of margin expansion in 24 months. The underlying economics are, on their own terms, extraordinary. The third is the liability. In February 2025, SpaceX acquired xAI, Elon Musk's AI venture, in an all-stock transaction valuing the combined entity at $1.25 trillion, with xAI itself ascribed a $250 billion valuation. For context on what $250 billion is being asked to represent, OpenAI tracks an annualized revenue run rate approaching $24 billion, while Anthropic commands a multi-billion-dollar position with a $400 billion valuation. Conversely, xAI, by available estimates, generates roughly $1 billion in revenue annually. It is being priced like a dominant platform. It is not a dominant platform. What xAI is precisely is this: an AI lab that was burning over $1 billion per month as of early 2025, whose entire founding team, all 11 co-founders recruited from DeepMind, OpenAI, Google, and the University of Toronto, had exited the company by March of this year. Every single one. After which, the CEO of SpaceX publicly acknowledged on his own social media platform that xAI needed to be rebuilt from its foundations. That statement, read carefully, is an admission that SpaceX just paid $250 billion for an asset requiring reconstruction from zero. The consolidated financial result of these 3 businesses in 2025, $18.5 billion in revenue with a net loss approaching $5 billion. Systemic capital dissipation at scale. And this entity, this combination of a genuine cash engine, a modest rocket operation, and a burning platform AI acquisition, is what Nasdaq is preparing to install inside your index fund. The Nasdaq 100 is not merely a list, it is infrastructure. Over $600 billion in assets across more than 200 investment products track this index passively. Inclusion does not attract demand,
it mandates it. Every fund mirroring the index is legally structured to purchase whatever the index contains. Inclusion is automatic buying. That is the mechanism. Under the prior listing infrastructure, SpaceX could not have accessed that mechanism. 3 separate requirements would have blocked entry. The first was time. A newly listed company had to wait a minimum of 3 months before Nasdaq 100 eligibility. That window exists for a specific reason: price discovery. Markets need time to find equilibrium between what sellers believe an asset is worth and what buyers are willing to pay. 3 months of active trading compresses information. It reveals the real number. The fast entry rule, adopted May 1st, compresses that window to 15 trading days. 3 months of price discovery becomes 3 weeks. The practical consequence: passive index funds are forced to buy before the market has had time to determine whether the entry price reflects reality or promotional mythology. The second was float. A company needed a minimum of 10% of its shares freely tradable in public markets before joining the index. SpaceX is targeting a free float of 4 to 5%. Under the prior rules, that would have been an automatic disqualification. Under the new rules, the minimum free float requirement no longer exists. SpaceX qualifies. The rule was removed. The third is the most architecturally sophisticated. Buried in Nasdaq's revised methodology is what can only be described as a synthetic float multiplier. For companies with a free float below 20%, Nasdaq now weights that float as if it were 3 times its actual size. A 4% float is indexed as 12% float. A 5% float is indexed as 15. This is not organic demand. This is manufactured demand, institutional capture through definitional manipulation. The index treats a minority liquid company as if it were broadly owned, then forces hundreds of billions in passive capital to respond accordingly. 3 rule changes. Minimum seasoning window, eliminated. Minimum float threshold, eliminated. Float size synthetically inflated by a factor of 3. All adopted simultaneously. All adopted approximately 6 weeks before SpaceX's reported June IPO window. The probability that this is coincidental is not worth computing. Index fund inclusion is the passive vector. There is also an active one. Standard IPO allocations direct 5 to 10% of available shares to retail investors. SpaceX is targeting 30%. Brett Johnson, CFO of SpaceX, stated on the record to a room of institutional bankers that retail would constitute a larger allocation than any IPO in history, because, in his words, retail buyers had been incredibly supportive of the company and of Elon, and the company wanted to recognize that. Translated into precise language, the largest IPO in history is directing 30% of its supply toward a buyer cohort selected for emotional loyalty rather than financial analysis. Cognitive dissonance as an acquisition strategy. The buyers most likely to anchor on brand identity rather than cash flow multiples are being prioritized for allocation before insiders can unlock their shares and before passive funds complete their involuntary purchasing behavior. The sequencing matters. Buyers are forced in early. Sellers, insiders sitting on a near-zero cost basis, are unlocked later. The capital transfer flows in one direction, from retail accounts and passive retirement vehicles absorbing shares at peak promotional valuation toward early holders exiting into that manufactured demand. Portfolio manager George Noble named this plainly. Your 401k is the exit liquidity. This is what the SpaceX IPO actually is. Stripped of the orbital photography and the mythology of interplanetary ambition. A 3-unit conglomerate where a high-margin satellite engine is structurally forced to subsidize a depleted AI asset bleeding $1 billion monthly is preparing to list at $1.75 trillion. To do so, the exchange on which it plans to list rewrote its inclusion rules 6 weeks before the offering. eliminating the seasoning period, eliminating the float minimum, and synthetically tripling the float weight to manufacture passive demand. Simultaneously, the CFO announced retail allocation at 3 to 6 times the industry standard, targeting buyers selected for brand loyalty. The mechanism is clean, the architecture is precise, and the outcome is structurally predetermined. Passive index investors, people who chose index funds specifically to avoid the asymmetrical information disadvantages of stock picking, will be compelled to purchase an unprofitable company at a promotional valuation, with no vote, no input, and no awareness that the rules were rewritten to make it happen. Passive investing was sold as the intelligent default: low fees, automatic diversification, set it and forget it. All of that remains true, but embedded in the structure of passive investing is an involuntary purchasing obligation. Whatever enters the index, the fund must hold. That feature, the one that makes passive investing frictionless, is the same feature that makes passive investors guaranteed buyers for anyone who can engineer their way into the index. Someone just engineered their way in. The question is not whether you will own SpaceX. You will. The only variable is whether you understand at the moment of purchase exactly what you are holding and exactly who sold it to you.